This was a week about how company directors and their key executives should behave on the one hand, and also how the Federal Reserve Board, the Fed over in Washington, will behave in terms of controlling the global money environment. First, let's look at the situations in a number of companies where the key issue of governance was raised, and the most potent was, of course, Newcrest, where the directors have admitted to a breach of the disclosure requirements last year in that controversial episode where we saw analysts suddenly downgrading their forecasts on the company, which is Australia's biggest gold mining company, and then a week later the company coming out and saying, we've had a terrible time, we're going to have to write down the value of our assets by at least $5 billion, and we're going to do all sorts of nasty things. It seemed to be a very clear case of the company briefing selectively those analysts, and something that was not appropriate and indeed was illegal. Well, the bigger story is sort of more complicated but also more simple, i.e. we had a stuff up rather than a conspiracy, because the company had made it very clear at its half-year profit announcement some months earlier that things were turning down sharply, and we really didn't have to. This was no great secret because the gold price had taken a big plunge running into this, but they believed they'd got the message out more explicitly that they were going to cut production, and when the analysts were still forecasting very high production numbers, they felt they had to massage down those analyst predictions. Well, to cut a long story short, the simple truth of the matter was they should have just told everybody. They should have made an announcement, not go through this absurd ridicule of trying to massage down analyst forecasts. Very simple lesson for company boards and directors, executives: tell your shareholders the truth. The second situation was Woodside, where we saw Woodside buying back a big parcel of its shares or agreeing to buy back a big parcel of its shares from its major shareholder Shell, and Shell also selling most of the rest into the market. Really raised an interesting question of whether a company should engage in that sort of practice. Shareholder wants to sell out, let it sell out. Why should the company spend company money to buy back those shares? Well, the justification is that it is in the interest of all shareholders, A, to buy back these Woodside shares from Shell well below market, although to pay for them they're going to use up some of their franking credits, and secondly, to remove this overhang, which would be damaging of potential selling, which would damage the share price going forward. So it would actually benefit shareholders to do this. I still have a bit of a trouble though with the company engaging in this sort of activity. Very interesting situation. The third one was much simpler, Aquila, where the major shareholder Tony Poley said he would accept the lower bid from Bayo Steel, the big Chinese steel company, in the absence of a higher offer, and he rejected the proposal from fellow WA company to engage in a merger from Mineral Resources. He was really putting his own interests and that of his shareholders first, because if Bayo Steel walks away, this company is not going to be worth the price that Bayo Steel is prepared to pay. So it would be clearly against the interests of both Tony Poley as a shareholder and shareholders generally for him not to have done this, to frustrate that bid from Bayo Steel. Finally, on Friday, of course, was the Westfield Trust situation, where the proposal to merge with the Australian assets of Westfield finally got over the line. Again, this is a very mixed situation. Now, clearly, the directors have made this proposal because they believe it is in the interests of the security holders. And at the end of the day, it got 76% of the votes cast agreed with the directors. If it had gone down by only about 1%, I'd have trouble with that as well, because the majority will would have been frustrated because it needed 75% approval. You have to ultimately trust directors to make decisions in the interests of shareholders. I think that's the big lesson that comes out of the Westfield situation. Finally, on the other hand, the Fed. What will the Fed do with interest rates in the United States and thereby impact on the whole global financial situation? Well, we saw again this week where bad news is good news. Because the US economy growth figures are being downgraded by the Fed, the prospect of it raising interest rates anytime soon, or indeed until we get well into 2015, has receded further and further into the distance. And obviously that was good news for share markets. Lower interest rates mean higher share prices. And so we saw the Australian market surge on Thursday, and it was a very good thing that the Australian market got that good news and surged on Thursday, because otherwise it would have been down for the week. We saw the market rise only slightly over the week, but for that Thursday surge it would have been down quite sharply. So really this is going to be the fundamental driver of the Australian share market going forward over the next few months. The uncertainty about when the Fed will start to raise interest rates in the United States, because that will drive Wall Street and it will also drive the value of the US dollar.